Hello and welcome to another market update. Got a lot to get into today with all the crypto nonsense. Don't worry, we'll touch on it. But before I get there, let's go over a summary of all the stories I'll be touching on today. Starting with the Federal Reserve last week raised interest rates by 75 basis points. The US added more jobs, but unemployment edged higher from 3.5 to 3.7%. Meta this week says it's cutting 11,000 jobs.
Oh, hell no!
I believe it's something like 13% of its workforce, but huge number, a lot of big tech firings. Next, we have UK is set to announce a huge natural gas deal with the US.
Say what?
Regulators are setting tougher climate impact rules after the annual climate change conference, the COP27. And then finally, our big story, crypto and the FTX token plummeted as the market battles the FTX ALAMEDA contagion. All right, but before we get into all this madness, let's quickly go over the stories from last week. Get a quick recap. So we had US Q3 GDP beat expectations at 2.6%. The latest ISM manufacturing numbers signaled the slowest growth since 2020. U.S. job openings unexpectedly rose by over 400,000.
Yep.
The ECB raised its interest rates also by 75 basis points.
Whoa.
Japan spent a record amount on its yen intervention. Something like over $40 billion, which is crazy.
For real? You fuck with that?
There were rumors of China reopening and easing its COVID restrictions. Technically unfounded, but rumors nonetheless.
Right.
President Biden threatened oil companies to lower their gas prices.
Come on, man.
We'll see. And finally, Tether fired back at Bloomberg's misinformation.
Little bitch.
All right, with that out of the way, though, let's transition into our first story. So we got the FOMC meeting, the interest rate decision by the Fed. So I'm going to start off by reading the initial press release, which originally the market took as, dovish, and so market started to rally. But then Powell came back in and really showed everyone his true colors.
Yep.
So recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Now, another thing I wanted to point out, so I highlighted all the times they mentioned inflation here, just to, highlight how much of a focus it is for the Federal Reserve, because a lot of people think recession or some other type of slowing economic tail risk is the focus, or it's at least starting to become more of a focus. But right now, the Fed and Powell are almost solely focused on inflation. And until they stop mentioning inflation like 100 times in their press conferences and really making it the focal point of every single speech and piece of work that they put out, that there's no reason to believe that they're going to pivot until inflation gets back to a normalized level. So I just want to get that out of the way. And for if you're watching this, you can see just how many times in red I highlighted inflation. It is all over the place. And the fact that it's in the first statement right here and also mentioned in Powell's speech, I'll get into a little bit of that. But it is definitely their focus. So don't think that recession is, not on his mind, but it's definitely inflation at the forefront.
Totally.
All right. Anyway, that ran out of the way. So the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the federal funds rate by 75 basis points. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy. Now, this is partly why people view this as dovish, because they mentioned right here the lags with which monetary policy affects economic activity and inflation. Because that's been a big story recently, that the Fed raising interest rates, the effect of those interest rate hikes don't really hit the economy until much later down the road. Some monetary policy effects with variable lags. It's kind of a nod to Milton Friedman. I believe he was the one who kind of mentioned that or popularized it. But anyway, this is largely why I believe that the market viewed this as positive, because Powell acknowledging that there will be delayed effects and that their interest rate hikes maybe haven't materialized in the economy yet. But he kind of backed off of that, or I guess switched to, the more hawkish version of himself in the actual speech. But this is, again, why I think the market kind of rallied or viewed this initial statement as dovish. So continuing on, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, otherwise known as quantitative tightening, as described in the plans for reducing the size of the Federal Reserve balance sheet that were issued in May. The committee is strongly committed to returning inflation to its 2% objective. I don't know how many times they have to mention it, but until inflation gets, maybe I would say probably under like 4.5 or 4%, you're not going to hear about a pivot unless something crazy happens, like a massive liquidity crunch, credit crisis. I don't know, but they could not mention it more, that they are getting inflation down to 2%, which, may or may not happen, but still, that is what they are saying. So you should take them at their word. Don't fight the Fed. All right, last little bit. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. So again, being data-driven and I guess remaining nimble, as all these central banks have been saying they will do. Like that is their plan, their forward guidance, or lack thereof, I suppose. So the committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings in public health, labor market conditions, inflation pressures, and inflation expectations, and financial and international developments, possibly something like the gilt market blowing up again. They do acknowledge that, I believe, in a financial stability report. I'm not going to get into that and bore you with it. But they are acknowledging the risk of the dollar rising and the instability that leads to in international markets, not just domestic. Still, I think they're going to take the stance of, our currency, your problem. But anyway, I digress. So before I transition away from this, pivot, if you will, I'm going to play a little bit of Powell's speech, just what I believe is the most important part, to give you a gist of his message at the core. So let's go ahead and take a listen.
With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
All right, so the key takeaway there is basically the terminal rate part of it, where Powell said specifically that the terminal rate, meaning the highest point that the interest rates will get, is going to be much higher. And that is significant because ultimately that's what matters the most in terms of overall tightening, because you can change the pace of interest rate hikes, 25 basis points, 50 basis points, going down from 75. But if the ultimate terminal rate, the highest point that these interest rates are going to reach, is higher than expected, that is really what matters. And so that is the huge most important takeaway, I believe, from what Powell is saying here, because that means regardless of the direction or the pace of the interest rate hikes, they are going higher than the market expects or originally expected, and that's obviously a big deal. But so that's enough about Powell. Bottom line, he turned into the most hawkish hawk out there, and he is really trying to break what a lot of people refer to as the Fed put, which means the price that markets correct to, at which point the Federal Reserve steps in to be the savior. But don't hold your breath, because like I said, he is being very clear. He's not being dancing around the words. He is being as straightforward as possible, basically just telling people, listen, I'm going to destroy markets.
And we say bye-bye.
But anyway, let's transition. So we got our next story. Unemployment. So the unemployment rate in the U.S. increased by 0.2 percentage points to 3.7% in October, up from September's 29-month low of 3.5% and slightly above market expectations of 3.6%. The jobless rate has been in a narrow range of 3.5 to 3.7 since March, suggesting that the labor market is already very tight, which in turn is likely to contribute significantly to inflationary pressure. That's kind of why Powell is trying to, kind of terrible to say, but increase unemployment, because he wants there to be downward pressure on wages. And as long as the labor market is tight, there's probably going to be upward pressure on wages. And a big metric that he points to is job openings versus relative to people seeking jobs. So it sounds terrible, but he's literally trying to increase unemployment. So this is, in his eyes, technically a good sign. The direction is again, in his eyes, headed the right direction. Obviously that's terrible, because you got hundreds of thousands of people becoming unemployed, but I digress. So the number of unemployed persons rose by 306,000 to a total of 6.06 million in October, while the number of employed decreased by 328,000 to 158.6 million. And then the overall labor force participation rate edged down to 62.2% from 62.3%. Nothing huge, but still meaningful. Now, as you can see, that unemployment has, we had several months in a row that was 3.6, 3.6, 3.6, 3.6, just remaining static. And then we dropped a little bit, but then moved back to 3.7. So Powell is not seeing really the exact reaction in unemployment that he wants. There's no real trend at the moment. You could say the trend just started, moving from 3.5 to 3.7. But over the previous months, they've been hiking rates for some time. I know they act with a lag, but we're not really seeing anything yet. So this is hardly a sign to think that he's going to hit the brakes on his hawkish stance, especially because I think he has a goal for unemployment. Again, sounds ridiculous, to get to around like 4 or 4.5% at least, which we're still far away from. So we got one more employment related story. So the U.S. economy added a stronger than expected 261,000 jobs in October, above market forecast of 200,000, although it is the weakest reading since December of 2020. Figures continued to point to a strong, albeit slowing labor market as worker shortages persist.
Totally.
So you can see, even though we technically beat expectations, because that sounds good if you see the headline, expectations were really poor. Like, they were really low. Like, we were expecting them to be bad, so beating them isn't necessarily a good thing, especially when you look at the trend that we are just headed lower. We are adding fewer and fewer jobs, and we're probably going to get to this level, this kind of like asymptotic decline where you can't, I guess you can technically remove jobs, but in terms of adding new jobs, it'll probably just gravitate closer and closer to zero. But you're probably not going to see any crazy spikes down, considering it already is so low. But the important thing to focus on is the trend. And monthly job growth has averaged 407,000 thus far in 2022, compared with 562,000 per month in 2021. So 261,000, which is basically half those numbers, is not a good sign. But yeah, so these are, it's funny, the market actually reacted well to this, rallied because they believe that this is a sign that Powell's getting what he wants. Again, that unemployment is rising, the job market is cooling off, and so, rallied because they thought, he's going to pivot, whatever. But again, this is one part of this larger trend that he wants to see for a long, long time. And by long time, I mean, probably like 6 months or something, to ensure that inflation is down. He's not going to pivot off of the first sign of some sort of trend shift like a lot of these market participants are maybe expecting. So you got to keep that in mind. Powell's trying to play the long game because he wants to tackle inflation for good, not, maybe possibly tackle it and then have it resurge, come back with a vengeance like in the 70s, which is his playbook right now, and then have to tackle it again with even higher interest rates or just complicate things in that way. So he's going to want to see more of a trend than just this. So personally, I think the rally was kind of stupid, wasn't more nearsighted than really taking everything into consideration, especially considering Powell's stance. But anyway, let's transition to our next story. So Meta, and they're not the only ones, but I'll get into it. So Meta cuts 11,000 jobs. And like I mentioned in the beginning, I believe it's about 13% of their workforce. So pretty wild.
That crazy.
And Meta Platforms said on Wednesday it would cut more than 11,000 jobs, or 13% of its workforce. So yeah, actually that was today. I don't know why I thought that was maybe earlier, but yeah, so that was today. So 13%, huge amount, 13% of one of the biggest companies in the world gone. So as Facebook parent doubled down on its risky metaverse bet amid a crumbling advertising market and decades high inflation. Whoops. So not only has online commerce returned to prior trends, but the macroeconomic downturn, increased competition, and ads signal loss. I think the ad thing was related to Apple. They dramatically impacted their ad revenue just because I forget what it actually is, but it was something basically giving people the option to like stop tracking or stop ad tracking. Apple kind of promotes transparency, and I don't know, maybe they were trying to fight Facebook, but essentially a move that Apple made around advertising and like privacy, transparency, they impacted their ad revenue substantially. So that's just one leg of this. But yeah, so ad signals loss have caused our revenue to be much lower than I'd expected, and that's CEO Mark Zuckerberg saying that. I think that's all I have. But there was one other bit in here. Where is it?
Oh my God, who the hell cares?
So Meta, once worth more than $1 trillion, is now valued at $256 billion after losing more than 70% of its value this year alone. Now, obviously, a big part of that is related to just the overall market, macroeconomic landscape changing, but still remarkable. I mean, they're dropping more than a lot of other names, so there has got to be something going on there, right? But 70% of its value. I mean, we got Facebook, or Meta Platforms, trading like an absolute shitcoin.
Yeah.
I think there was another little bit. Yeah, right here. So the mass layoffs among the biggest this year and the first in Meta's 18-year history follow thousands of job cuts at other tech companies, including Twitter, Microsoft, Snap, and I believe a few others. But Meta is just the headline of this story, obviously. But I partly wanted to bring this up because a lot of big tech names are either freezing hiring or straight up firing people. So we are seeing a huge shift in, I guess, these companies' outlooks and them trying to buckle down and prepare for what they maybe view as a, tough next few months or years. But this is potentially not a good sign. I mean, again, if these big companies like Meta, Twitter, what have you, can't handle the changing landscape, whatever, the cost of capital increasing with interest rates going up, whatever it may be, if they can't make it and they're cutting jobs, we're probably going to see that reflected in small business and really the economy more broadly.
Aww.
But on that cheery note, let's transition to our next story. All right, so the UK recently, they announced a US gas deal after Climate Change Summit. So the COP27, I believe it hasn't actually happened. They announced that there's going to be an announcement, something like that.
Whoa.
But British Prime Minister Rishi Sunak is poised to announce a major natural gas deal with the United States after the COP27 Climate Change Summit. Britain hopes that the United States will promise about 10 billion cubic meters of liquefied natural gas, LNG, over the coming year, adding that discussions about the deal are in their final stages and an announcement could come in a week or two. Now, obviously, everybody knows that Europe and the UK being part of that is struggling with their, with energy right now because of all the natural gas, oil, whatever it is, I guess all that stuff kind of clumped together from Russia is just gone now. So they're trying to contend with that and find supply of natural gas from other sources. And that's mostly, I believe, Canada, the United States, and Qatar. And they are, if they're going to play the long game and they're not going to get Russian gas this month, this year, next year, whatever it is, they're going to have to secure some sort of supply from other places. And that means, like I said, Canada, the United States, or Qatar. So that's, I believe that's basically what they're getting at with this. Now, again, the specifics of the deals are not released yet because that hasn't been completely announced. But this is a big deal because you're going to have a lot of European countries basically battling for all this LNG, shipping LNG overseas. And what's interesting is LNG previously wasn't really a global market, partly because it's so expensive to liquefy it and transfer it. It's not like oil that's just easily transportable over ships and stuff like that. It's more logistically challenging and economically expensive, and that's why it hasn't really been viable or something that countries reasonably do until this happened, with Russia. But as that continues to be a problem and they're not able to secure natural gas from Russia or any other source for that matter, they are going to have to pay up the ass for all this liquefied natural gas from other countries, because for it to be economically viable, it has to be expensive, because otherwise it doesn't make sense for a country like the United States or whoever to spend that extra money to liquefy it and send it overseas. So you're going to have this premium for a while on natural gas that is, it's going to start bleeding into global markets, because like I mentioned previously, natural gas has been somewhat disconnected in different markets. That's why you can have the European natural gas prices skyrocket while the US natural gas prices, they did go up, but not nearly to the same extent. And a big part of the reason they went up was because of us exporting it out. And so there's like this natural arbitrage that brings that spread tighter and tighter. Not even close to where, it matches, but, maybe that will happen sooner. Anyway, let's continue on. It's actually pretty much the last bit. So Britain's national grid has said that Britain's ability to secure gas supply would depend upon its prices being high enough to attract exports from Europe and LNG from countries such as Qatar and the United States. And I believe Canada is also included in that, but maybe not to the same extent. Either way, this is a pretty big deal just for the long term of natural gas and I guess energy more broadly, because there's going to be a premium added. If you're taking Russia out of the market, prices are going to have to go up elsewhere. It's just how it works when you have, a finite supply like a commodity and, a global market. So wanted to mention this story because I thought it was a big deal. Let's transition though. All right, so this is also about the climate, annual climate meeting, the COP27. Actually, I'll just read the headline. So, corporate climate pledges rife with greenwashing. And for those that don't know, greenwashing is essentially pledging to, enact policies or live by whatever way to help limit climate impact, and then not really do it in practice. So it's like greenwashing, where you're lying about or like feigning interest in the green agenda.
Totally.
Okay, with that context out of the way. Promises by companies, banks, and cities to achieve net zero emissions often amount to little more than greenwashing, UN experts said in a report on Tuesday as they set out proposed new standards to harden net zero claims. Too many of these net zero pledges are little more than empty slogans and hype.
Little bitch.
Group chair and Canada's former Environment Minister, Catherine McKenna, said during a news conference launching the report, bogus net zero claims drive up the cost that ultimately everyone will pay. Regulators across the world are starting to set tougher rules around what activities can be deemed environmentally friendly. Yet progress is patchy, and campaigners and activists are increasingly turning to the courts to challenge weak claims. On Tuesday, an official at Australia's corporate watchdog said it was investigating several companies over greenwashing, in which a company or group makes exaggerated claims over the environmental impact of their products or practices. And last bit If this report becomes a legal standard against which one can measure if a net zero commitment is bona fide or not, then it can provide ammunition for the lawsuits and regulatory action which are sorely needed to make the absence of climate action more expensive at the individual company level. All right, so what does that all mean? It basically means they're going to get, like regulators that is, are going to get harder, stricter about climate-related regulation and policies. And now look, longer term, I think it is good for us to wean ourselves off of fossil fuels, promote cleaner air, less pollution, all that good stuff. But we need to be cognizant of the fact that we are not able to abandon energy, fossil fuels as it stands right now. Now, down the road, we may be able to get to there. Obviously, that is kind of the hope. Again, I am in that boat, but we are not there yet. And the issue with these policies and kind of stifling all these energy companies with excessive regulation, in the short term at least, is you're probably just going to exacerbate this global energy crisis that we're in right now, and which could easily continue or worsen in the future given the underinvestment and lack of supply. So if you're increasing the cost to these energy companies by adding all these extra regulatory requirements or whatever it is, you're probably just going to hurt consumers in the short term. With already high energy prices, you're just going to exacerbate that. Now again, I don't necessarily have a problem with the underlying goal or direction of this, but I don't think all these people implementing these regulations or laws, policies, are really thinking all that rationally about the energy market and how this is going to affect prices and just the future of energy in general. Because again, we're not really out of the woods yet. We cannot throw the baby out with the bathwater and just abandon fossil fuels at the moment. For better or for worse, we do need them. Our whole entire society, economy, globally is just unimaginably dependent on oil and gas. I mean, even just petroleum products, which is like 20% of oil demand. That is a huge part of our need for oil, and renewable energy doesn't replace that, nor does it replace transportation fuels like for planes or large ships that we all need for global commerce to take place. So increasing the cost because of the pollution or the climate impact of these industries that we do really need at the moment and probably for the foreseeable future is just going to drive up costs. And again, not necessarily a bad thing to move us in the right direction long term, but in the midst of a global energy crisis, it doesn't really seem all that prudent or all that helpful, if you're trying to tackle inflation. So lesser of two evils, I guess. I don't know. But either way, definitely look out for this, because who knows if this is a little bit more like just talk, but it's possible that we start seeing stricter climate-related regulation hit the markets, and who knows what that means for investment. You're going to have big firms like BlackRock basically making energy companies uninvestable, which again would only exacerbate the problem. All right, well, that's enough ranting. Let's get to our big story. No, I think it's actually there we go. So, now, for anyone who hasn't heard, I'm sure everybody has heard about the story at this point. It's pretty much all anyone can talk about. But recently, FTX token fell 80%, but really the whole crypto market kind of took a huge dive on this contagion fear. And so let me map out kind of like what happened. Basically, a CoinDesk report was released outlining FTX's balance sheet. And they basically showed that a huge portion, I think they have like 14 billion or something in assets, and a huge portion of those assets were tied up in ostensibly illiquid assets like the FTT token, which is the utility token for the FTX exchange, and SOL, which is the native token for the Solana blockchain. And now, regardless of what you think about these coins, I'm not trying to hate on them, but they are illiquid, relatively speaking, especially if you're trying to trade in size. And when you're talking about billions of dollars on their balance sheet, I think it was like 2 billion or 3 billion in FTT and like another 1+ billion in Solana. And you get a margin call, like those are supposed to be your liquid assets to meet, customer withdrawals or other liabilities, of which they had like 7 billion. And so they weren't able to meet that, at least that was the suspicion, because they were holding such illiquid assets. So investors started to be scared, and you basically had a bank run dynamic that led to them getting, the FTT token collapsing, getting margin calls and just basically going insolvent. So this is a huge issue, and there's a lot of contagion just because a lot of people invested in FTX, and if FTX goes insolvent, what does that mean for the money they owe to investors or whatever? So we're really just at the beginning stages of the potential contagion, and who knows how far this is going to ripple through not just crypto, but even the broader economy, because you have a lot of VC funds that hold other assets. They hold things like Apple, they hold things like, just other big names in US equities or, treasuries or whatever it is. And if they have to sell assets because of their involvement with FTX, then that's going to bleed into traditional legacy financial markets too.
That crazy.
But with that out of the way, let's just transition to this actual story. So the FTX exchange token FTT went into free fall Tuesday, even after the company got a lifeline from larger rival Binance, as fears mounted over the crypto trading firm Alameda Research's financial woes, fueling what appeared to be contagion, driving down prices broadly across digital asset markets. So FTT fell to $4, down more than 80%.
Damn.
And that was just over the past 24 hours. And Solana, or Sol, I should say, the native token of the Solana blockchain, fell to $21 from $30. I think it was like a 40% drop. I mean, it's all just so volatile right now that, at any moment you look at this, it could be up or down another 10%. So, and I guess, actually, I can tell you right now. So, at the time of this writing for this article, it said FTT was trading at $5.56, and I have it right here. It is at 2.4. So it is down another 56% today. It's down since I literally just got this measuring tool out, and it's down another like 10%. So unbelievably volatile, and you can see just from basically where this drop started, it is about a 90% drop. So basically the FTT token is completely gone.
And we say bye-bye.
Which means, if you think about the implications of that for someone like FTX or Alameda, they had so many of their, like a huge portion of their assets were held in FTT. So if the value of FTT is gone, the value of their assets, that they're basically backing their liabilities for customer, deposits or whatever it is, then, they can't meet that. And that's part of the problem. People got worried about it because if you're holding all your, or a good portion of your assets that are needed to kind of support withdrawals, your liabilities in this ridiculously illiquid token, whatever, it's drawing into question the, a lot of the risks that you have, because like it just happened, you're probably not able to meet those withdrawals if you really had to, because you go to sell FTT on the market, and what is the bid? You don't know. Like it may say, mark to market, that it's like, X amount of dollars, 3.6 billion, whatever it may be, and then you go to sell and you can only get like 1 billion out of it because it's just not a liquid market, and you're just going to put downward pressure on it. So that's essentially what was going on. I'll continue on with the story. So CoinDesk reported last week that Alameda Research's balance sheet is loaded with highly illiquid FTT tokens, and is also a big holder of SOL tokens, which is not, I would imagine, as illiquid as FTT, but still, it's not nearly as liquid as, Ethereum or Bitcoin or, any other asset really. So some of these tokens were put up as collateral to take out loans. So not only was it just held as an asset to back some of their liabilities, but it was put up as collateral to take out more loans. So, as FTT falls in value, you get margin called, and you have to post more collateral. So that just added to this whole debacle. So as of June 30th, Alameda held 3.66 billion of unlocked FTT tokens and 2.16 billion of FTT as collateral. So you have, what is that? Almost, like 5 billion, over $5 billion in FTT or as FTT collateral, which is a huge amount to have in this one of the more illiquid coins, relatively speaking. Obviously, there's like, you got like Cum Rocket or whatever that, that crypto was, and that's probably way less illiquid, ironically. but FTT is not capable, like that market is not liquid enough to handle billions of dollars in the event you need to pay off deposits or meet some sort of margin call. And that's what led to this cascading event. So its SOL holdings totaled about 1.2 billion. So it's over $1 billion more they have in a relatively illiquid market. And investors, having found this report or seen this report by CoinDesk, they feared that the giant Binance exchange bailout of FTX might not extend to Alameda, which is a significant market maker and lender in the crypto space. This is part of the contagion thing. FTX and Alameda are technically separate entities, but they're both started and kind of run by Sam Bankman-Fried, SBF. And part of, I guess, the suspicion, again, this is speculation because it hasn't really been, nothing's been really borne out yet, but that FTX was basically using their FTT collateral, or Alameda was using it to issue loans. And there's just a lot of witchcraft going on in the background between the two, where they weren't really separate entities. They were kind of using each other's funds, using customer funds to trade for Alameda as their market maker, and they're a crypto hedge fund proprietary trading firm. So this connection that they had is largely what people are speculating has led to the problem, them not holding customer funds and just kind of giving it to Alameda, vice versa, whatever it is. These two companies are married together. And, because of that, Alameda might face margin calls and be forced to fire sell assets from its balance sheet to raise liquidity. So again, adding to the contagion issues, because who knows who is an investor in Alameda. And so, it just has this ripple effect, because if they get margin calls, aren't able to meet things, their investors are now going to have to, sell their assets, which can lead to fire sales in other markets. Or just crypto. I mean, I don't know. I really doubt it's going to stick to just crypto just because of how big FTX is. But, we'll find out. So Alameda's route could spell trouble for the broader crypto industry, including lenders exposed to the trading firm and to crypto ecosystems, which Alameda and FTX have been heavily invested. Assuming Alameda doesn't survive, there could be a good deal of pain, particularly for the Solana ecosystem in which they were deeply involved, and any institutions that lent to Alameda. So like I said, the extent to this contagion is, we're in the beginning stages. Who knows exactly how far it will go, but this is a huge story because you have one of the biggest exchanges in all of crypto essentially collapsing. And, there's rumors that Binance is going to buy them out, but I wouldn't hold your breath. It doesn't necessarily make sense for them to do that. And even in that, if that did happen, it's not a guarantee that people will get all their money back. They might, get paid out at 10 to 30 cents to the dollar or something. But, regardless, not good optics for crypto. Not a good day. But hopefully this encourages people to focus more on counterparty risk and proof of reserves. Find an exchange with proof of reserves, because that is going to become increasingly important when you have people lending out deposits and basically engaging in excessive fractional reserve banking. So proof of reserves is going to be important, and also just getting your crypto off exchanges. There is no counterparty risk if you get your own, not your keys, not your coins. If you take custody of your coins, there is no counterparty risk. So you don't have to worry about this nonsense. So hopefully that's a lesson learned. And if you lost any money, sorry to hear about it, but now you know. All right, well, that does it. But before I get out of here, let's transition to what we can look forward to next week. Okay, so tomorrow we have U.S. inflation numbers come out. Headline CPI is expected to decline to 8.1% from 8.2%, but core inflation is expected to edge higher to 6.7% from 6.6% the previous month. And core inflation is more important because, more important in the sense that the Fed focuses on core inflation. When they're talking about getting inflation down to 2%, they're talking about, core PCE, technically this is core CPI, but either way, core inflation, which is, less food and energy. So if core inflation is expected to go higher, that is not good, even if headline CPI is expected to go lower. No! All right, and then on Friday, we get UK GDP numbers. Year-over-year growth is expected to decline to 2.3% versus 4.4% the previous year. and quarter-over-quarter growth is expected to decline to negative 0.4% versus a positive 0.2% the previous quarter. Now, I think somewhat recently, the Bank of England has predicted or projected a recession for the next 2 years, a 2-year-long recession. So this could be the first quarter of many to return negative prints. And I wouldn't, obviously, minus 0.4% is not crazy. I imagine if you were projecting a 2 years of a recession, it's probably going to get worse than that. But yeah, so potentially the start of many negative GDP numbers to come. And then next Monday, Japan GDP numbers come out and are forecasting a drop to 0.3% from 0.9. Not really a big deal. And then Chinese year-over-year industrial production numbers are expected to decline to 5.6% from 6.3%. And finally, next Tuesday, the U.S. Producer Price Index, which is often considered a leading indicator for inflation because it's related to business expenses and like commodity inputs, things like that. Those numbers come out, and the forecast is a drop to 0.3% from 0.4%. Now, if expectations are right, that is a good sign because that could be, like I said, a leading indicator for inflation to come down. But obviously, the real numbers haven't come out, so still possible that we surprise to the upside and inflation is far from over. But that is all I have for you today. Aww. So on that note, as always, stay happy, humble, and most importantly, talking to you, FTX, solvent.
And we say bye-bye.
Catch you all next week.